Okay. I know people are still eating, and I encourage you to continue eating, but it is a great pleasure for me to pick up the next session. For those of you who don't know me, my name is Jonathan Enton. I am the faculty advisor to the Law Review. My role here is to introduce our keynote speaker. Hester Peirce, since January of this year, has been a member of the Securities and Exchange Commission. At the time of her appointment, Commissioner Peirce was a senior research fellow at the Mercatus Center at George Mason University. She previously served as senior counsel to Senator Richard Shelby when he was the ranking member of the Senate Committee on Banking, Housing, and Urban Affairs. She also has served as counsel to SEC Commissioner Paul Atkins, as a staff attorney in the Commission's Division of Investment Management, as an associate at the law firm Wilmer Hale, and as a law clerk to Judge Roger Anderwelt of the U.S. Court of Federal Claims. Commissioner Peirce has edited 2 books, Dodd-Frank, What It Does and Why It's Flawed, and Reframing Financial Regulation, Enhancing Stability and Protecting Consumers. She's published many articles, book chapters, and working papers, and she has testified often at congressional hearings. This is a homecoming for Commissioner Peirce. She received her bachelor's degree summa cum laude from Case Western Reserve University and her law degree from Yale. She also studied on a Fulbright scholarship at the Technical University of Vienna. It is a great pleasure and a real honor for me to introduce Commissioner Peirce.
Thank you, Professor Enton. I appreciate that kind introduction, and actually you get a distinction of being the only one to ever introduce me to pronounce my judge's name correctly, Judge Roger Anderwelt, who was a wonderful judge on the Court of Federal Claims in Washington, and prompts me to give you all the recommendation, those of you who are in law school, to definitely find a clerkship with a great judge. It will transform your careers and your lives. He really made a mark on me, so I encourage you to do that. I really am honored to be here today, and especially I looked at the panels that you all have had this morning, we'll have this afternoon, and you're really getting a tremendous group of people to speak to you, so it's an honor for me to be here as well, though I can't promise the quality of what I say will be as good as what you've heard and will hear on the panels. I have to begin my remarks with my standard disclaimer, which is that my views are my own and they don't necessarily represent those of the Commission or my fellow commissioners. And that is usually no surprise when I start talking. It is a real honor to be back here at Case. It was a quarter of a century ago that I graduated from CWRU, and so it's wonderful to be back here. As a wide-eyed freshman, I lived just down the street in the North Side dorms. I took the LSAT right here in this law school. And on nice days, I used to study out there in front of the Art Museum, where I could gaze at the statue of Rodin's The Thinker for inspiration in my own thinking. Didn't know his work. That statue is one of approximately 10 large versions created during the master's lifetime under his watch. The museum acquired it in 1917, coincidentally the year that Rodin died. As you may know, the Cleveland version of The Thinker is not fully intact. The Thinker arrived whole and enjoyed more than 50 years of uninterrupted thought. Then, in the middle of a March night in 1970, someone placed a bomb underneath the statue, and the Thinker has continued to ponder for another 50 years, but the bombing literally knocked the legs out from under him and surely affected his thinking in some form or fashion. Today I want to talk to you about an attempt to knock the legs out from under many years of thinking regarding financial reporting and securities disclosure by public companies. Specifically, I want to talk with you about the role that financial reporting plays in giving investors a window into the companies they own. Recently, some people have suggested that financial reporting and corporate disclosure should perform other functions as well. I contend that we need to be very careful in making changes to something that is so central to the functioning of our economy. To understand its importance, it may be helpful to start with a quick outline of the financial reporting process itself. It's probably worth throwing in some history alongside as well. Financial reporting isn't new. For as long as investors have been investing in enterprises, one imagines they wanted insight into how their money was being used. Double entry bookkeeping, or debits and credits, began over 500 years ago. Later, during the Industrial Revolution, railroad companies found they needed a coherent system for presenting their operations to prospective investors, which paved the way for the development of financial reporting. Other companies then began to follow suit, and soon it became clear that there was a need for a reliable financial accounting and reporting framework. The framework would have to pull together existing practices and provide a uniform set of standards for companies to use so that investors could readily understand the financial statements of various companies. Generally accepted accounting principles, commonly known as GAAP, which was built on time-tested standards, brought that much-needed uniformity to financial accounting and reporting. By using GAAP, companies can produce financial reports that are consistent, which allows investors to compare and analyze different companies. The Financial Accounting Standards Board, or FASB, which was created in 1973, maintains the standards under the authority given to it by the Securities and Exchange Commission. GAAP are not static, so the FASB's work is always ongoing. It adjusts the standards as necessary as communications and other business processes change over time. Now, having very briefly skimmed the surface of a bit of history, we can dive into the process of financial reporting itself. The primary actor is the company. As the SEC's chief accountant, Wes Bricker, has noted, quote, high-quality financial reporting starts with companies. Before a company issues a single report, it creates the reporting environment through the development of appropriate internal controls at the company. These company policies dictate how the company will make its decisions, who has the authority to act on behalf of the company, how these decisions and transactions are documented, and what checks ensure that the company adheres to its own policies. A company that maintains insufficient controls will have difficulty presenting its financial condition accurately to investors. Equally troubling, the company's managers will have difficulty understanding its own financial condition, which makes management very difficult. Additionally, the company will be at the mercy of wrongdoers within its ranks if it lacks the proper controls to flag questionable activity. Federal securities laws now require these controls, but even without such a statutory requirement, only a foolhardy company would operate without them. Having controls in place is just a start. The company must document the controls and all authorized transactions in its books and records. This documentation forms the backbone of the actual financial reporting process. For companies subject to U.S. federal securities laws, the responsibility for maintaining books and records in reasonable detail is assigned to the companies themselves. Again, even without a statutory mandate, this arrangement makes sense. Companies are in the best position to maintain their own books and records. The books and records are the building blocks of financial statements that are comparable, verifiable, timely, and understandable by investors and others. Although financial reporting starts with companies, a number of outside parties also have a role in the process. People reading the financial reports might not be inclined to trust them simply because the companies say that they've implemented internal controls and complied with GAAP. So we bring in an independent third party, the independent auditor, to review the company's financial statements and issue an opinion on those statements. Auditors add credibility to financial reporting by performing procedures to determine whether the financial reports are presented fairly and in accordance with GAAP. For an audit to be effective, it must be objective and performed by auditors who are ethical, independent, skeptical, and who apply the diligence necessary to meet professional and regulatory standards. These auditors are overseen by the Public Company Accounting Oversight Board, which is a sort of odd quasi-governmental entity established to develop standards to ensure that these objectives are met in public company audits. Even before the establishment of Peekaboo, as I like to call it, after the Enron and WorldCom debacles, auditors were subject to professional standards which helped investors to trust the auditor's work. Auditors often serve as an attractive scapegoat when a company runs off the rails. For example, when a company has been poorly run and subsequently collapses, our first recourse should be to management, not to the auditors. While the auditors perform a vital function, their role is limited to ensuring that the financial statements are free of material misstatements. They do not assess whether a company is well run, nor is it their job to ferret out every instance of negligence or malfeasance at the company. A recent example of misdirected ire toward auditors comes from the UK. In January 2018, Carillion, a British facilities management and construction services firm, which was quite large, was forced to liquidate with only £29 million in cash, but $1.3 billion in debt. That's not good. The liquidation came shortly after the company announced an £845 million write-down on unprofitable long-term construction projects, the value of which declined at the same time that the company's debt increased significantly. Carillion's collapse left many wondering how a failure of this magnitude could go unnoticed for so long. In response to public outcry, politicians turned their sights on the auditors, some of these politicians are now calling for a breakup of the Big Four. I cannot and would not, if I could, offer any opinion on the quality of the auditing for the company, but I offer the example only to show how quickly and completely the public's attention can turn away from management and then to the auditors to blame them. Firms that assume the role of outside auditor do take on a heavy burden, and so they should. They are an integral part of our reporting system, as I described. They provide that credibility and that check, but we must be careful to lay on them only the burden they're designed to bear. The financial reporting process, as I noted, begins with the company, and the company is responsible for designing and implementing internal controls, keeping its books and records, and ensuring that management is held properly accountable. Blaming the auditors for the company's failures not only lays unjust accusations at the feet of the auditors, but also lets the company off the hook and reduces the incentives for them and for other companies to keep their houses in order. The SEC also has an important role in the financial reporting process. Our Division of Corporation Finance selectively reviews filings of companies to monitor compliance with financial accounting and other disclosure requirements. Our Office of Chief Accountant answers questions from accountants and auditors and works with the FASB and the PCAOB or Peekaboo and the international standard setters. This entire process, from developing and maintaining internal controls to auditing financial statements to reviewing and establishing accounting standards, is not a source of revenue. To the contrary, the process is a consumer of resources. Companies must devote staff hours, management attention, technology, and time, and then they must hire outside experts for this process to work. They pay for auditors and they fund Peekaboo and FASB. The costs incurred by the SEC in its oversight role are also relevant. They're part of the price that we pay for the financial reporting process. So why bother? Why should we focus so much energy and why should we pour so many resources into one area, into financial reporting? Investors need to have this information, so that's why we do it. They need to be able to make good choices about how to invest their money. Financial reporting is essential for effective capital allocation, which in turn is critical to our economy. Again, as our accountant Wes Bricker, our chief accountant Wes Bricker said when he spoke to the Institute of Chartered Accountants in England and Wales in June, quote, "An efficient capital allocation process would not be possible without financial disclosures because adequate and high-quality information helps investors to judge the opportunities and risks of investment choices accurately." There is not enough capital to fund every idea, so because funds are limited, we really need these financial reports. An accurate financial picture of a company, a picture that's comparable with the pictures of other companies, and a picture that is a credible representation of reality is a key input in an investment decision. These capital investments encourage economic growth by channeling funds to productive investments. Productive investments, in turn, are a boon to society. They produce life-saving drugs, new ways of processing data, and new ways of getting around. So in a way, the railroads, by setting financial reporting in process, paved the road for their future competitors to gain access to the capital markets, and thus railroads are less important than they once were. Public companies, pursuant to our securities laws, make disclosures in addition to the straight accounting disclosures. These disclosures provide the context for the financial statements. And again, the purpose of these disclosures is to help investors make an assessment about the long-term value of the companies, the shares of which they're buying, or the debt or companies to which they're lending money. Remembering why we engage in financial reporting and securities disclosures helps us to understand the limits and resist efforts to rethink the purposes of financial reporting. If information about a company is so important to investors, and by extension to the rest of society, wouldn't it make more sense simply to require companies to disclose everything? If information is good, more should be better, right? Not necessarily. In fact, almost certainly not. First, as I mentioned earlier, disclosure entails cost. There is, of course, the cost of gathering the information itself, but that's just one line item on the bill. And reviewing the information, ensuring its accuracy, and presenting it in a way that's consistent with the law is costly too. Such review and presentation requires the assistance of experts, very expensive experts, such as lawyers and accountants. And of course, there is the cost of incurring the legal risk. Every disclosure an issuer makes can give rise to a lawsuit by the government or investors, and they can challenge its accuracy, its completeness, or whether everything is properly disclosed. So both the potential for legal action and the cost of such actions, and the additional attention to detail provided by those expensive experts, adds to the cost of disclosure. Lucrative for lawyers, but quite the opposite for companies, and ultimately the investors who foot the bill. So more is not always better, even from the investor's viewpoint. The more a company must pay to make a disclosure, the less money is left for shareholders to receive in the form of dividends or increased investment in the company. A company's shareholder may also worry that the disclosure of too much information could make it vulnerable to competitors. There is also investor cost in terms of the time that an investor spends wading through disclosures. Reliable, relevant information helps an investor evaluate whether a company's stock is a good buy. The investor is helped by having access to information that will help her make that decision, but she doesn't want pages and pages of disclosures that are irrelevant to the question of, is this company a good bet? How do we decide then what a company should or must disclose? Our federal securities laws have rested on the foundational principle that issuers should disclose information that is material to investors. A fact is material if, quote, disclosure of the omitted fact would have been viewed by the reasonable investor as having significantly altered the total mix of information available. This total mix has traditionally been understood to mean information about whether the company is likely to provide a return on the investment to the investor. In other words, investors need, and our securities laws strive to provide investors with information about the long-term financial value of the company. Materiality is a cornerstone of our regulations. In most cases, if a company omits or misstates a fact, the company faces liability only if the fact is material. For example, if a company miscalculates a number by a penny, it's unlikely that that misstatement is material. The reasonable investor is unlikely to reach a different conclusion about her investment in the company simply because the number was off by a penny. But if a company miscalculates by a much larger number, the likelihood that the misstatement is material is, of course, much larger. It will come as no surprise to you that what constitutes materiality has been defined in part, thanks to people like us, through litigation. If a company is facing litigation over an allegedly material misstatement or omission, one way the court will determine whether the misstatement was indeed material is to look at what happened to the company's stock price. So if when it comes to light that there was an omission or misstatement, if the stock price drops, then, and if it drops by a large amount, then we assume, hey, maybe it was material. But if it's a smaller decrease in the stock price or no decrease at all, maybe it suggests that the investors didn't find the information that important at all. As you can imagine, though, conducting these kinds of event studies can be pretty difficult, and so it's not the science that it's sometimes presented to be. The difficulty of putting limits around materiality has long bedeviled the SEC. In a speech 40 years ago, then Commissioner Roberta Carmel noted that, quote, "The Commission is being accused of substituting moral for economic or legal materiality." And she noted that people outside the SEC were pushing the SEC in that direction, away from economic materiality towards other conceptions of materiality. And she was worried about disclosure of matters which are not necessarily economically material. She was specifically speaking about environmental disclosure, but she said she hoped that that trend of expanding beyond economic materiality would not continue. Unfortunately, from my perspective, in recent years, there has been increased interest in expanding beyond economic materiality. People whose primary interests are not the long-term value of companies, i.e., not investors, have realized that there's power in our mandatory reporting regime and have grabbed hold of it for their own purposes. In recent years, there has been a call from some commenters to realign the boundaries of what must be disclosed by public companies and therefore what we deem to be material. If materiality is determined by asking what the investor would want to know, the argument goes, why should the inquiry be limited to asking what the investor would want to know about a return on investment? If an investor is interested in knowing about a company's labor practices, and if that information would significantly alter the total mix of information made available to the investor about labor practices, shouldn't that information be deemed to be material? Or if an investor cares a lot about the company's use of green energy, isn't all information relevant to that question material? Or if another investor cares a lot about how companies are using minerals from a conflict-torn part of the world, isn't that material? Or what about an investor who also owns a trash hauling company on the side, and that investor might be very interested in the company's waste reduction and recycling program because he has an interest in making sure that there's not too much waste reduction and not too much recycling going on so that his trucking business is still profitable. Isn't that information material? The answer to all these questions is no. First, there's a reason that we talk about materiality in terms of the reasonable investor. That modifier is intended to limit the language to ensure that a company is required to disclose information that is broadly useful to investors, not information that responds to idiosyncratic interests. The term material would come to be meaningless if it meant information important to any investor for any reason. While one investor may care deeply about labor practices, another may care about whether the offices all have recycling bins, and yet another may worry about whether the company is increasing investments in certain geographic regions of the United States. Materiality has a relatively stable meaning because it's not feasible to require the company to respond to every interest of every individual investor or groups outside of investors altogether. Second, even if a large number of investors wanted information about the same issue, the company's environmental footprint, for example, the process for reporting or auditing this information is simply not reliable in the way that financial reporting is. As I mentioned earlier, financial reporting is a process that has developed over centuries, with methods that work becoming codified and methods that didn't work being discarded. Not only are the accounting methods themselves time-tested, but the process from developing internal controls to documenting the implementation of those controls to entering transactions into the company's books and records to presenting those records for audit have been developed and refined over time. Additionally, for many issues that may matter to certain investors, the data are not settled. Audited reporting suggests that there are clear standards that can be uniformly applied across companies or even across industries. Soft issues like labor practices are simply not susceptible to this type of reporting or auditing, nor is it easy for a regulator to assess the quality of disclosure on many of these soft issues. Indeed, the Commission has struggled to implement the requirements for disclosure of non-material information that are driven by concern for constituencies other than investors. It's hard to know how to measure the effectiveness of such requirements. For example, 10 years ago, Congress directed us to require companies to make disclosures about the degree to which they or anyone in their supply chain are using minerals from conflict zones. The objective was to discourage companies from sourcing minerals from areas of conflict, and thus the hope was that you could deprive the gangs which are engaged in rape and murder of revenues that are helping to fund their bad activities. That information is really hard to come by. And just incidentally, a lot of people in those regions were quite angry at the SEC for this rule because it ended up adding to their misery by companies were just pulling out and not wanting to buy minerals from those areas at all. At the same time that requirement was placed on the SEC, Congress directed us to disclose mine safety violations, which are already disclosed elsewhere and may not be material. If they are material, they would have had to be disclosed already. But contrast these requirements, so those are sort of softer requirements, with the disclosure requirements that we adopted earlier this week with respect to mining companies. Specifically, we updated our requirements governing how these companies disclose the extent of their mineral reserves, any obstacles to mining, and their plans for marketing the minerals they extract, and other related information. This information is really important to investors. They want to understand the value, if they want to understand the value of the company. And so they're much more straightforward for us, not easy. There were lots of tricky issues with those disclosures too, but they're much easier for us to implement. Accounting itself isn't black and white. It depends on the art and judgment of the accountant. Given the variability present in what seems like such a straightforward presentation, the amount of money a company has, how much is coming in, how it's spending it, more nuanced information would clearly face even more considerable challenges. Consider, for example, a question such as what are the company's overseas labor practices? What factors do we care about in answering that question? Perhaps that is not even the starting question. The starting question may be better phrased, what factors should we care about? What is the purpose in asking the question? Often it's hard to determine whether workers are well treated, but what does well treated even mean? How will we define this? What data will we use? How do we determine which data are relevant? These questions may be answered in 5 different ways by 5 different investors. Whether certain practices indeed benefit workers may vary wildly by industry and location. They may even vary by the idiosyncratic preferences of different workers themselves. Of course, treating workers well is one way that a company can help to build its long-term financial value. So I'm not trying to suggest that companies not treat their workers well. In fact, companies may choose to publicize detailed information about how they treat their workers. Not only is that a great recruiting tactic, but it also might be a great way to appeal to customers. And companies often choose to make disclosures they are not required to make about any number of issues, from labor practices to recycling efforts to other environmental practices. But even small steps away from the established parameters of financial reporting can raise red flags. For example, the International Accounting Standards Board, or IASB, has recently released a conceptual framework that placed a new emphasis on stewardship. Whether that change alone will result in a change in accounting standards is difficult to say, but the use of this word gives me pause. At the time the framework was released, however, the IASB noted that the term stewardship had presented difficulties for the international body, given the challenge of appropriately translating such a meaning-rich word into various members' native languages. Even in English, it can be hard to say definitively what stewardship might mean in the financial reporting context. As one scholar has noted, it can mean management's honesty in husbanding the enterprise resources, or management's efficiency in utilizing them, or even providing the shareholders with a suitable return on management's employment of resources. To the extent that stewardship means simply that the company has implemented adequate internal controls and is deploying its capital to economically productive ends, financial reporting can indeed assist investors and creditors in assessing management's stewardship. The quality of stewardship in this context is audited already under existing standards. But to the extent that the term means something broader, that it encompasses, for example, an inquiry into whether management is doing a good job, things get much murkier. Financial reporting has always been about financials. These financials provide insight into how a company operates, but they do not tell us directly about people. The uncertainty that a word like stewardship presents is the uncertainty of trying to apply the same concepts that can provide a reasonably accurate picture of a company's financial system to a much softer set of variables, such as its management situation. Additionally, once we have opened the door to applying financial reporting to one set of non-financial variables, it's too easy to try to apply them to others, such as the so-called sustainability factors that I discussed earlier. Thus far, the IASB has not taken any concrete steps away from its core purpose, setting accounting standards. The IASB is equivalent to the FASB. Indeed, the chairman of the IASB has remarked that the IASB is not well equipped to address sustainability reporting and that, quote, the world of sustainability reporting does not provide the same kind of global comparability that exists in the world of financial reporting. I very much agree with this. Financial reporting loses its value when it's applied too broadly to circumstances not amenable to its standards or processes. While there are those who see mandatory disclosures and audited sustainability ratings as a way to affect social change, the financial reporting structure is simply not designed for such ends. Investor protection requires us to think carefully about what we require companies to disclose, what gets audited, and what metrics we use to assess companies' performance. It is so easy to fall into the trap of assuming that investors will always favor more disclosure or will always want disclosure about issues that have captured the imagination of the broader society. But that's simply not true. Our financial reporting and corporate disclosure system is essential to well-functioning markets, which are, in turn, essential to the ongoing provision of the goods and services that make modern lives so safe and comfortable. This system has served us well for many years. When we seek to bend this system out of its proper shape, we risk undermining the value it provides. Whether we do that by trying to audit principles that are essentially unauditable, by expanding the scope of audits to information that would never be deemed material in the past, or by making auditors the guarantors of management to an extent never intended, we do violence to a system that has historically served our markets well. Financial reporting deserves more respect from us than that. So too, when we attempt to pack our securities disclosures with items that are not directly relevant to the company's long-term financial value, we diminish the value of those documents to the investors for whom they are intended. Thank you all for your time. I'd be happy to take some questions. I think there are a lot of really important issues here, and I'd love to hear your comments and concerns. Thank you.
Thank you, Commissioner Peirce. And for those of you who do have questions, please wait for the mic so that they can get picked up on the webcast.
I can hear you.
Thank you. Is that working? Okay. Thank you, Commissioner. I agree with your remarks. So you at least convinced one person.
Wonderful.
So a comment about the disclosure issue and one of the things you talked about with conflict minerals and such. I think it's notable that the additional disclosures about things like conflict minerals are not really about investors. They're sort of things that the public might want to know. And it's remarkable that these rules are not applied to not public companies. So private firms who, Koch Industries or something, they're also sourcing things from Africa. And if the public wants to reduce the use of conflict minerals, you would think they would want them to do so as well. And I think the reason we don't have these disclosure rules, the not investor ones, applied to private companies is because we can just bootstrap them through the securities laws as opposed to Congress passing a separate statute that would require these disclosures for everybody. So I would be in favor of splitting off the not investor things like conflict minerals, pay ratios of CEOs to average workers, all this stuff that's political. And if we're going to require companies to disclose them, all companies should be required to disclose them, and Congress should have to legislate on that front. And one of the ironies is the more we pressure companies to disclose things that are not meaningful to shareholders, the more companies opt out of being public companies. And so if the idea is we need transparency about public companies because corporations, we need to hold them accountable, the more we make them disclose, the fewer of them we get, and we see that in the number of companies that are going private and opting out of the system. So the push for transparency actually leads to less transparency. Thank you.
So, I think there are a lot of great points there. It is true. So I was working on Capitol Hill at the time that this conflict minerals provision was put into the law. And it was really interesting to meet with people. There were other provisions as well. There's a provision about resource extraction. It's really interesting to meet with people who wanted those disclosures in, and it was a bipartisan effort. This was, there were groups coming in that were bipartisan, and they came in and they said, we found this really great thing. We found the securities law disclosure framework, and it's great. You can make companies put stuff out there in the public, and everyone gets to see it. And they said, we're so excited that we can use this framework for whatever our cause of the day is. And I said to them, do you know what the securities laws are for? And they said, no. And I said, well, they're actually for investors. And they said, oh, really? And then they moved on, and they managed to successfully get the requirements put in the statute. So I think they're just looking at it as a convenient vehicle, as you mentioned. I think another important point that you make is that because of the disparity of public-private, so these requirements apply to public companies, it's one more reason why companies think before they go public, they think, well, do we really want to sign up for a regime where we have no idea what kind of requirements are going to be placed on us? It's one thing if you sign up for the regime and you know that I'm going to be required to disclose things that are material to the reasonable investor. But it's another if you're signing up to provide whatever the flavor of the day desired disclosure is by any group out there. And so I think a lot of companies are deciding, forget it, we don't want to be part of this regime where we're basically playing Russian roulette. We don't know what kind of costs we're going to be subject to. And I should say on that conflict minerals disclosure, that's been an extremely expensive requirement for companies, just because tracking through your whole supply chain to try to figure out where minerals are coming from is actually quite difficult. So anyway, I think you raised lots of great questions.
Is the statute?
Oh.
Is the actual statutory or regulatory intent behind the underlying law available to rely on now in kind of combating this?
You mean underlying the securities laws?
Yeah. Can't you simply point to that and say, listen, it was never intended for this. This was the legislature's intent when they drafted these provisions. Nothing's changed since then. So.
Well, for a textualist, it's a little hard for me to want to go back to legislative intent, but you're right. I mean, that is definitely an argument I use, so I admit to going back to that. But frankly, it's not a very. It turns out that that argument never seems to win the day, because people find ways that they argue that these other things. Well, here's the materiality hook, and so. You can always find a materiality hook, and that's what people try to do if you press them on the point. And that's why people who advocate these expanded disclosures have really tried to move to a softer notion of what materiality is, because then it's not based on a number, like what 5% or of your income would definitely be material, but it's not based on a number, it's based on this more nebulous concept.
And one other thing I would point out just is that it seems to me that there are like funds available for people who want to invest based on their faith or based on their political views. There's all kinds of aggregate, mutual funds or other ways of investing. So if you truly want to be a conscientious investor, there are ways to do that. But if you simply want to invest your money for the purpose of building your money, then you can do that by way of trading common stock, and you can get whatever information you would like through the prospectus, and if it's not sufficiently transparent, then you can pick another entity.
Yeah, I mean, and I think that's a great point, that there's, you can, if there are enough of these investors who care about these kinds of things, the company is probably going to disclose these kinds of things because they want to attract those kind of investors. But there are funds that do specialize in that, and they go to areas other than the securities disclosures to find information that's relevant. So if your fund doesn't, I mean, there are funds out there that won't invest in companies that sell guns. There are other funds that won't invest in companies that sell alcohol. If you want that, you can find someone who will do the legwork to find that information out for you.
To the earlier point, the number of public companies has gone down by about half in the last 10 years, something like 7,000 to 3,000 or some numbers like that. To what extent do you think that is from the regulatory regime or other factors?
Well, I think there are a number of things going on there. One of them, of course, I have to say, because we're in a law school, is litigation. I think that's a huge factor. So if a company's stock price drops, it will almost undoubtedly face a lawsuit. And those lawsuits are extremely expensive to defend against and usually end up settling regardless of merit. And so you have to factor that into your decision about whether to go public. There's another aspect which I think is what we talked about before. You don't know what you're signing up for. You might end up having to comply with all kinds of crazy expensive regulatory requirements. There's another piece as well, which is that one of the main reasons to go public is so that your investors are able to sell their shares when they want to. So it allows for people to buy and sell very easily if it's public. Now, one thing that a lot of smaller public companies are finding is that when they do go public, so excited, finally people are going to be able to buy and sell my shares easily. It doesn't work out that well because our market structure is not really well suited for these smaller companies. So I think the SEC has a lot of work to do on multiple fronts to address the problem of why companies aren't going public. I got a preview of this question, so I'm happy.
Actually, it's a little different.
Oh.
So I've written a paper with Stephen David Solomon on called The Limits of Disclosure. And our argument is that one of the reasons there's so many disclosure requirements is that so many people politicians, legislators, want to be seen as doing something. And the easy thing is just, we're just going to ask for some disclosure. For instance, maybe the public is outraged at CEO compensation. Nobody's going to say, well, nobody should make more than X million dollars or something. So they say, well, let's just tell people about it. We already tell them a lot. Let's tell them more. So the point is here that when you say, well, people are putting all this stuff in that actually doesn't make a difference to investors, then the next question is why? It might be, somebody has some misplaced sense of horrible things happening in Sierra Leone, which they do, and what the relation to the disclosure requirement is, another story. But it may also be against we got to do something, and they can't, as I say, agree on something substantive and difficult, and this is just the path of least resistance. So if that's the case, and that's the force that your view is up against, what do we do to counter those kind of somewhat pernicious uses of disclosure?
Yeah, and I mean, full disclosure, no pun intended, I also am responsible for some of those types of arguments because it's often easy if someone wants to place a substantive requirement on public companies, which I argue is generally not within our purview, it's historically not the role of the SEC to do that. The response is, well, okay, we shouldn't mandate it. Why don't we just tell companies they have to disclose it, so if investors think it's important to have a company that has a separate chairman and CEO, then that's disclosed, and so then we've taken care of that problem. So I think it's very easy to fall into that trap of just trying to use disclosure as an easy way out. And I think it's just, the fact that we have so few public companies now is maybe a little bit of a check on that practice because people are starting to see, oh, wow, we're really imposing real costs on folks. So maybe that's why we don't have as many public companies. And so maybe that helps us pull it back. But, human nature is human nature. And so people are always going to think, well, one more little disclosure requirement. It's just one little check the box. It won't hurt. But, even a little check the box requirement can end up being pretty costly for companies, especially small companies.
So I also found your presentation very persuasive on the issue of materiality and the ways in which materiality can be used to smuggle in non-investor type issues into the securities laws. A related issue, though, it seems to me, is the way in which indexing and the role of a small number of passive funds controlling a large amount of invested capital can also smuggle those sort of non-investor issues into the securities laws, or at least into corporate governance. And I'm thinking sort of the Larry Fink worldview as a way of voting a lot of passive capital. And I wonder, it seems to me there's a connection between the materiality issue that you were presenting on, and I wonder how the SEC is sort of thinking about the encroaching indexization of the world and the power of those folks who run the indexes over sort of corporate governance levers.
Yeah, I mean, that's a great set of issues to bring up as well. I think it's something that we are thinking about at the SEC, and just more broadly, our Investor Advisory Committee recently, which is an outside advisory committee to the SEC, had some panels on indexes and passive investing. So you mentioned Larry Fink, and Larry Fink is associated with BlackRock, which is a massive manager of mutual funds and ETFs. And so if they come out there and say, these are the things we're going to be looking at in the companies that we invest in, people listen because they've got a lot of power. If they go to an index provider and they say, we don't want a company to be in your index if the company has this kind of a governance structure, index providers are going to listen. And so there's a lot of power being exercised by those folks. And then there's also another group of people, proxy advisors, who give advice to investors about how to vote their proxies in companies. And so if the proxy advisor, lots of people rely on two proxy advisors. So if one of those or both of those proxy advisors say, here's how you should vote, it's going to really have an effect. So we are seeing lots of these, massive shifts because of the decisions of a relatively small number of actors. So it is something that I worry about, although again, I will say that investors can decide whether or not they line up with what Larry Fink says is important to him. They can decide that, I think maybe I don't want to have BlackRock manage my money, or I do want to have BlackRock manage my money because it looks good or it doesn't look good to me. So investors ultimately, as long as all that is transparent, as long as the person managing the money is telling the people for whom he's managing the money how he's going to make decisions, I think that's fine. However, I think often those people who manage money for other people assume that their pet issues and interests align well with the investors for whom they're investing money, and that's not always true. So you see, for example, pension funds, often these are massive investors, state teachers, for example, their pension funds are massive investors. And what does the teacher who's retired care about? Well, that teacher cares about whether or not she can fund her retirement, whether or not her pension will be paid out. The people managing the pension plan might have lots of other social goals that they're trying to achieve that have nothing to do with whether or not that pension gets paid out. And so there can be a conflict. That's an agency problem that we have to take into account. But I think ultimately, the fact that we will always have a segment of our investing population that's activist, especially if you get more and more people doing this passive investing where you just follow an index and I invest in the S&P 500 and that's it, or I invest in this index of small cap stocks and that's it. Because there's that group, it'll make it even more profitable for an activist investor to come in and say, well, I'm going to pick the companies that are actually well managed and that are managed for long-term value. So I think we'll get balance, but these are definitely interesting issues because we're seeing so much money now in these passive index-based investments.
Commissioner, one item of information that Congress has mandated, financial information, is the pay ratio between CEOs and average workers. Can you comment on how that mandate fits within the principles you've stated and what kind of effects that mandate is having or may have on public companies?
One thing I can say is that every law school I go to, I always get asked about the pay ratio. So I know that at least People in law schools are interested in the pay ratio. So the pay ratio requirement was essentially, people were pretty worked up about the fact that CEOs were making so much money, and so they said, let's require companies to disclose what the ratio is of the CEO's pay to the median employee's pay. And so, that's great. So the SEC gets this mandate, and the SEC, this was before my time there, said, how in the world do we implement this? Because literally in the world, because you've got some companies that are employing contract workers in Bangladesh, you've got other companies that only employ high-cost engineers, and so how do we present this ratio, or have companies present this ratio in a way that's comparable and meaningful? Should you count independent contractors, or should you only count employees? How can we make this make sense? And there was a lot of back and forth, and I think a lot of concern on the part of companies. But indeed, it has been an issue of great interest for the media, who have really grabbed on, because journalists love numbers like that, like, oh, GM, this is what their pay ratio is, and comparing to some other company, and they can compare that, and it doesn't matter that it's apples to oranges. It's just fun to write about. And so there have been lots of articles written about the pay ratio, but I would argue that it's not a good measure. I would argue that it is not only not material, but it's potentially misleading. We've done our best to try to make it not misleading, but I think it's information that to a reasonable investor is not relevant. Oh yeah, disclosures that are not material often do influence how companies are behaving. So again, that may not be, though, in the best interest of the investors, to whom I think companies' managers have the first responsibility. But again, lots of people are interested in the pay ratio.
So it's been mentioned in response to a couple of questions that there are these activist funds for people for whom these issues are a concern to use their money to support their goals. I guess my question is, isn't it important then for the market to be able to act in that way, for those people to be able to use those money and show that is a thing that the market cares about, for that information to be disclosed so that those funds can intelligently manage their money in that way?
Yeah, that's a great question, and I think, so here's how I think about it. I think it's, that is what those activists, a lot of the activist funds do push the SEC to make disclosures. For example, tell us whether you invest in guns or whether you sell guns or not, because that's what we need to know to manage our fund. The problem is that I can think of a whole array of funds. So, I really don't like shoes that aren't made of leather, right? So I want to know if the company that I'm investing in or maybe we'll take it the other way, right? A person might really be opposed to leather, so the use of animal products. So then we need to get the company to disclose every instance in which it used animal products, because that's key for that activist fund, which is a no animal products fund. And then there's this other activist fund on the other side that does not want to invest in any company that is in any way involved in abortion or birth control. So you've got another set of disclosures to answer that. And then you have the funds that are really only concerned about whether the company is using only organic food in its cafeteria. And again, I may be exaggerating slightly, but you can imagine a whole array of funds. And so I think that really does go back to the point to say one investor's idiosyncratic interests, however important they are to that investor, may simply not be important to other investors or material, and they're making their decisions. So I think that's why I always want to come back to that cornerstone, which is trying to figure out, is this good for the long-term value of the company? Because that's the thing that we can normalize across all investors. if you try to put in these other things, it pulls the company's reporting system in so many different directions. It's so hard to figure out how to do it. And as I say, it's not only these social issues, but it's also, if I'm investing in two companies and my investment in company A is much bigger than my investment in company B, and company B happens to rely on A as a supplier, I'm going to care. I want to know about what company B is thinking about whether it's going to retain that supplier, because my primary interest is company A. I have only a small interest in company B, but I'm going to ask them to disclose all this information to protect my primary interest. So I think we have to remember it goes not only to idiosyncratic social interest, but idiosyncratic financial interest, where something that's not material financially to the company might well be material financially to one individual investor.
One thing you just mentioned was focusing on the long-term value, and that the current disclosure system should focus on that. We had a prior panelist talk about the emerging concern between wealth maximization and kind of shareholder opinion that may be more social. So if we look at the public firm as something other than solely a wealth maximizing vehicle, does that change the analysis? If we look at it more of as a social firm, do we then look at what needs to be disclosed and say, this doesn't need to be solely for long-term value, or that long-term value may be social and not simply financial? So I'm not sure.
Yeah, I do think it changes the analysis. So I think that if you're going to set up a company that wants to operate for reasons other than profit, that's fine. And I think we should allow that in the law. And in fact, a lot of states do allow for benefit corporations, which allow sort of consideration of other factors. And then I would argue that the disclosure becomes different, because you're trying to talk, the company is not all about long-term value maximization. It's not maximizing the value for the shareholders. You may have explicitly said, we're going to make this company about labor, or we're going to make this company about the environment, and we don't care if we take a hit to our profits. But I will say that as a regulator, that does worry me a little bit as I think about how I'm going to do my job, because it's really hard for me to know how I set the standards for that. That said, I think we do have to leave room for people who want to set up companies that operate that way. All right, well, you guys can go have a break, and I appreciate your time. Thank you.
Okay, we will take a short break, and we will reconvene at 1:15 for our next session.